Aloha Thursday morning, ladies and gentlemen. It is the 8th of January, 2026, just beginning this new year. I don't know if you're excited, but I'm excited. This marks my first calendar year of being a full time trader, trading for a living. And in the process of doing that, one thing that I'm doing to ensure that I will succeed and succeed to the greatest potential I can is that I am challenging myself to deliver information to YouTube every day about trading that will help beginners and intermediate, and hopefully someday I can have a good enough delivery where I can even help out advanced people in the market. So that's what I'm doing. Right here is my Thinkorswim desktop platform, and you can see that it's not the paper money account, it's the real account because there's doesn't say anything about paper money up here. And um and I'm just going to keep it on this screen right here for the moment, and to take a look at the what's happening before the market opens. This particular chart setup I have is looking at our trading during the between the market hours. So as you can see right here, this black area here, this is Wednesday, and then where it becomes this kind of grayish area, that is Wednesday after 4 p.m. And then this dotted line here, this is midnight, and then going forward from here, this is Thursday. So we see yesterday for XLF, it was a day that it sold off. And then once it sold off to a certain point, it started kind of going sideways. After the market closed, it dropped down a little bit more. And overall, it's kind of been going sideways to lower. So we see it started going sideways here and it's lower. So, and because the S&P 500 is kind of doing the same thing, we see it's trending under both both moving averages. However, these two moving averages are tightening up, and we see that it's kind of it's challenging this white moving average here. It's challenging it. It's attempting to move up above. And we had a similar thing with the S&P 500, although in the after hours there was much more of a sell off, and then about halfway in the evening sold off here, and then it's kind of been going sideways. And same thing, but less of a challenge to this white moving average. What do we see? Sort of the same thing with Qs, sort of the same thing with the Dow Jones. And as usual, we have a different look from the Russell 2000, which is on top of both of the moving averages. And it's challenging this white moving average to the downside versus these are challenges to the upside. So overall, we got 3 out of 4 going kind of down the sideways, one moving up, and so we need to figure out is this one going to just go on its own path, or are these three gonna get in line with it, or is it gonna get in line with these three? I mean, if the 3 out of 4, we would think that maybe it's gonna uh, it's gonna get in line with these three. However, I don't really know for sure. This will be my first full 12 months of annualizing my attention on that particular topic. And that's what I'm encouraging you to do, not necessarily to a great of a degree that I am. However, I would encourage you, if you want to make the most money out of the stock market as you can, then doing something like I'm doing really gives you the best opportunity because I'm not glued to my computer, but I'm at my computer every day the market's open. And it gives me an ability to watch things and learn about things and test things with paper trading, with real accounts, learn from other people, read, work on things, be productive. And I don't have to be glued to something because I really haven't been day trading. I'm personally setting up my situation where I will be day trading, uh, and I will be day trading, but with the current switching of Schwab reducing my trading level to option level one trading, it has caused me to need to and continue to adapt and relearn things. And I'm happy to have 2026 to do that. So that's the way that I'm looking at it. Is 2026 is a strong focus on building more of a dividend portfolio and having dialing in level one option trades. Time frame, I'm really open to it. I'm open to day trading. I'm open to position trading, and I also have another computer here that I am putting more paper trades in. At some point, I'll pull up the paper trading account and show you some things. However, you should be proactively doing your own paper trading as well. And one reason why I am forcing myself to get in the habit of paper trading is to be a better example. And how can I tell you that you should be paper trading if I'm not paper trading? And I know it's so valuable that I have such, even though I know that it's so valuable, but what I'm experiencing at the moment is, and what I have been experiencing in the past, and what I'm attempting to deal with in the moment is that my real life account, I have two computers going on, two laptops, one laptop and two laptops and a extra display. And so the computer that is like the faster computer, that's usually what I'll have my live account on, which is what I'm making this recording on right now. And then this other computer, which is lower RAM computer, and that one I'll tend to have um, in the past when I was in Hawaii, I would have paper trading on it. Now, since I've moved to Michigan, I have had my live account on both computers for a certain amount of time, and um, and that is because I want more displays with the live account, and um, and so I'm getting to this point of I'm one reason why I want to deliver content onto YouTube is there's certain things that I want to be in the habit of being aware of, like how for me I feel unsatisfied with this situation where this should be something that I would know as a stock market um, proficient person, is that if there's three major indices, what on an annual basis are they normally all going the same direction, or is it normal for these three to be this way and this one to be this way? I'm sure I could find out. I'm sure I could put it in to some internet search. And if you say, well, use AI, I kind of just say internet search to come. Let's say computer search. So however my computer can search, I put it into a computer search, try to come up with the answer. That's good. But the other thing is that until I was looking at this stuff every day, I didn't even realize this was a question. And so there's a value in annualizing our attention on things. And I believe I believe that although I don't call it a superpower, I believe that if you join me on this journey of annualizing our attention on the stock market, in 12 months from now, your comprehension and your ability to interact in the stock market will seem like a superpower to other people. And they won't really know how you're doing this, especially once you get into year three. If you're looking at the stock markets annually, and you're not only looking at the stock markets annually, well, that's good. That's the first start. But to get in the game, you're looking at how much money you're able to extract from the stock market annually. So it's an annual game, and so you need 1 year to see how much money you can squeeze out your first year. if you watch it for 1 year and you don't even try to squeeze any money out, that's you didn't really play the game. You just watched the game. And so uh, I'm inviting you to be on this journey with me. Now, you don't have to spend as much time watching these markets and trying to figure out all these small nuances yourself, because I'm definitely going to be doing that. And I encourage you to do that. But what I'm also attempting to do is deliver relevant information for people that are trying to do this. So I'm doing it myself. And maybe there's some people that want to do it. Maybe there's some people like me in the past where I was working a full time job while I was trying to learn this stuff. And I was working a full time job. At some point, I started taking real action. I was trading with real money, and I was still working a full time job. And I was, I would say the first time I was successfully trading real money was 2012. So in 2012, I was working a full time job, but I had enough option option courses where I felt comfortable dealing with option chains, and obviously not as comfortable as I am with it now. But 2012, I started learning in 2007. By 2012, I was pretty comfortable with option chains, and also I started learning about the stock market in 2007, and it was more from 2007 to 2012. It was more on the option side, but 2012 I started learning about stock charts, and for me that was really pivotal in this journey, because up until then I realized myself, I came to this conclusion. I was like, you know what, all these different trades, these are great, all these different strategies, but if I cannot choose, if I really don't know the direction of the stock, like it doesn't matter. And so I went on this binge of like trying to get good at non-directional trades, which I think is really how I eventually really tuned into um, being where I eventually tuned into short naked strangles, because it's um, it's like not really that directional, and it's a non-directional trade, and so it's kind of like a iron condor, but has a lot more theoretical risk to it. And I think that iron condors, because of the extra legs, I felt like it made it more complex and complicated and harder to deal with. Where when I'm selling naked strangles, I'm able to get further away from the strike price. Sorry, I'm able to get my strike price further away from where the stock is trading, because I don't have to buy that insurance. So if I can get some premium way out here at 30, and even though I'm taking this risk, but it's so far away, I might not get much premium, but maybe I want to get paid, and I'm only going to take a little bit of money. I'm good with getting paid a little bit of money, because I'm taking a smaller risk, versus coming up here to 25 or 22, where I'm taking a lot larger risk, but I'm getting paid a lot more for that risk. So it's a it is a it's a dance. It's an art form of doing that. And so you're blending a mixture of statistical, scientific, mathematics with artistry, and that artistry is coming from your understanding of the world in which you live and how the stock market functions. So it really becomes important at some point to understand the world in which you live. Now, for the average person in the market, they don't do that and they get average results. I personally don't want average results. I want way above average results. So I'm doing things like this, delivering you content that, number one, should be helping me, and it is helping me. It's helps me keep on track and keep me more committed to looking at things like the Buffett indicator, like the Shiller PE ratio, like the MMRI, which all of them have been, continue to be high, elevated, warning signal. And then also to get more into looking at these put to call the put to call ratios. Now, at first, I was looking at the at ETFs like the S&P 500, and what I learned though is that I think the futures are the better look. That doesn't mean don't look at the S&P 5 the SPY because they're a representation of the same thing. Neither of them are the S&P 500, but they're representing it. So here we have S&P 500 via the futures, and it's bearish. It is bearish. The put to call ratio is almost 2, 1.858. That's bearish. Let's see if anything is showing up under just SPY. SPY, I'm not. I'm guessing this is from yesterday, how it closed out. Almost 10 million contracts, quite a bit, and it is a little bit on the bearish side. And let's look at SPX. And whoa, SPX also a little on the bearish side. I haven't been looking at this one as much lately. I will tune into this, so I'll be able to let you know this in the future. But I'm wondering what this volume, like on SPY, the volume on SPY was almost 10 million. I think it was 9,500,000. Yep, and so that's pretty normal. This is average range right here. That's nothing out of the ordinary. So even though just on the SPY it is looking bearish, since I started focusing on put to call ratios on SPY, this has been somewhat normal. And where is SPX? I think that was like 5 million, 4 million. Okay, 4 million, 4.5 million. So I'll pay attention to that more. And I'm thinking that paying attention to the futures, SPX, SPY, we could go so far as doing like the \MES, but I think these three are a pretty good look at the S&P 500 in those three. So overall, yesterday leading into today, there's definitely a bearish tilt to the put to call ratio for the S&P 500. And let's check the Qs. So since there's this bearish, and I think we're going to overall see as we look at all the indices that there's more of a bearish tint overall for the put to call ratios. And also, as I said, the MMRI, the Shiller PE ratio, the Buffett indicator. So unless you really know what you're doing, if how confident do you feel like you know what you're doing? And I'll give you one question that I ask myself and that I use to judge myself on skill. How well can you beta weight your whole portfolio? How well can you do that? If you don't even know what I'm talking about, then you should be cautious right now. If you have no idea what beta weighting your portfolio means, if you kind of have an idea of what it is, but you don't know how to do it, like you could not beta weight your portfolio today or in 48 hours. If you couldn't beta weight your portfolio in 48 hours and you would take the most amount of that time researching how to do it, if you couldn't just do it like you were tying your shoes, then maybe you want to be cautious. That's the way I'm looking at it. I'm being cautious. I have made myself really cautious, and so let's look at these cues and being cautious because everything's kind of bearish. Cues. Let's look at the actual. Look at the actual. What do I mean the actual? Let's look at this ETF. What is the Q index? I'm not sure. I don't remember off the top of my head. I think I could find it. Bearish over here, and we'll look at the Dow Jones because I know that one. Bearish 1.5. Russell 2000. This one seems to have the least amount of volume on it, and or maybe it kind of fluctuates between the diamonds and the Russell to have which one has the kind of lower volume. And I think it was on the the Dow Jones futures. That one might have been really low on volume. Yep, look at how low on volume it is. It's not even, it's bearish though, because there's two, but there's two puts. So all the other ones we've seen had at least like 44,000 on them, up to 10 million, and we have two here. So this one, even though there's not a lot, it's still, because we're looking at so much, we actually get a good idea here that even though there's not a lot of volume, the volume that's there is 100% bearish. Two of those. Is that really true though? Is it 100% bearish? Because what if, like, I would have to find out if these were bought or sold. It just says there was two. It's not telling me if they were bought or sold at the moment. And maybe I'm maybe through some information here I can figure it out. I'll look into that into the future. Keeping this video around 20 minutes. We're right there. So overall, ladies and gentlemen, be cautious. There's the only thing that I can really see, two things that I can see that I'm watching for myself, that for bullish scenarios is, number one, the stock market is a mechanism that has a tendency to go up. So because of that fundamental inherent nature of the thing we're dealing with, we should be assuming that sooner or later it's going to go to the upside. Right now, it's and because of that, because it has this inherent nature to go up, we should understand that that somewhat kind of mutes movement to the downside. So, when the downside movement comes, though, it's going to come generally pretty fast and rapidly. And to the upside, it can be slow and steady. And so that is like kind of the mechanism we're dealing with. And then we have um, overall a lot of bad economic fundamental data, not so much on individual companies, although that is reflected with the whole zombie company things. That zombie companies, I don't really hear people talking about them, but it was something that people were talking about a lot in the past. And I think it's possible that these zombie companies, uh, I think maybe even a better illustration would be like anchor companies. They're dead weight. They're dead weight. They're slowing things down. And like right now, like I would say this is an example of slowdown. If this is a mechanism that has a tendency to want to go up, and and overall three-fourths of it are kind of going down to sideways, then I could see that, because it's not like dropping too hard. And if we, the Dow Jones overall on monthly chart, it looks bullish. And let's look at SPO. Actually, do the bullish, bullish. Now, in the last, let's say since 2021 or so, um, maybe it's 2023. Last 3 years, um, we've got the last 3 years from left to right. We're looking at a big picture on the monthly candle, and man, we just see this screaming bullish. However, the last three candles here, this one was red. This is the first red one in 1, 2, 3, 4, 5, 6, like 7 months, 6 to 7 months. The first red one, and now sideways a bit with these small bodied candles. So it's slowing of momentum. And we got over 7,000 on the futures. When was that? Sometime this month. Sometime in, yep, this month. We got over 7,000 on the futures. So hit all time highs, and still I think that there's some time to be cautious because if we were in this really just raging bull market, then I think Robinhood would be popping off. That's one thing that I really I really view this as this company has great earnings. It has great earnings. All this stuff that is really great about this company, but money isn't flowing into these tech companies right now. Money kind of flowed out of these tech companies, and I guess Robinhood is viewed as a tech company, but I'm viewing it as a brokerage firm, and it's closer to like a bank, but it's trading in the sector, I guess, more of like tech company or something. I don't know exactly, but what I do know is that because this price is going down, money is flowing out of it. And why would money be flowing out of a really profitable business? Maybe because overall, the way money's flowing in the stock market right now versus this individual business. So to me, that is kind of um, a bigger indicator, and it goes in illustration with the overvalued Buffett indicator, the high Shiller PE ratio. We're in these times where we had all this great run up, especially after hitting these COVID crash type of thing in here, and it's been nothing but been green strong candles to the upside until the last three-ish months, three-ish trading months, and we'll see how this month's going to play out. We're still at the beginning; it's only the 8th of this month. We'll see how it plays out. We'll see how the rest of them play out. In the meantime, I'm still opening new positions. If I was doing option level 3 trading, I would still be doing that. I would definitely be selling naked strangles. Something that I will be doing in the future as I'm stacking more cash for option level 1 trading is wheel strategy. Wheel strategy on FCX, but also wheel strategy on Robinhood. And why Robinhood? These two illustrate this is around the $55 area right now, but that's kind of at the high end of the range. And I wouldn't be surprised if sometime in the future this pulls back to like 40 or 45 or something like that. At that time, I think that I would consider um, putting on a position at that price, or maybe selling cash secured put options at that price, or even a little lower at like 35. But as you go further down in the strike price, especially for FCX, as you're getting closer to the $35 strike price of a cash secured put option, you'll find that you have to go out in time. You have to sell more time in order to make money. There's just not much demand for the that strike price for shorter term contracts. Now, Robinhood, I think, can be played much the same way. However, obviously, you would need more money because this is $55 a share. We're looking at on the low of this of 116 and almost 117. I think I was going to stop this video like 10 minutes ago, and let's look at Robinhood real quick and then stop this so I can get on with my day preparation. Robinhood, look at the put to call ratio here. Very bullish on the put to call ratio. And let's see how that's made up. Less than 200,000 contracts, 162,000, with almost 100,000 of those being calls, 63,000 being puts. It's giving us this 0.633 put to call ratio. And I usually will start around 22 or 30 days to take a look and start gaining an idea. But we don't really have 30-day here. We've got 22, 29, 36. I'll just go with the 22. You can go up and down, whatever. Well, one thing I'm noticing right away is that we got lots of strike prices to work with, which is good. This makes it easier to make money with Robinhood's option chain because look at from here at the money, all the way down here to the 85 strike price, which is a 2 delta, we've got choices available to us. How many? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18. I could have been off one, but about 18 strike prices available. Now let's contrast that with FCX. Now it should stay at the same days to expiration. FCX, you can see only strike prices only go down to a 13 delta. And 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 choices compared to 18. And you might find that oftentimes when you get to the higher, more expensive stocks, that tends to happen. So in here, then, what would be going on in the big picture without really getting into the nitty gritty details? You would have to have a minimum of $10,000. If you had $10,000, you could sell a cash secured put option on Robinhood for 22 days at I don't think that's a, let's see, yeah, at about a 12 delta, 12 to 7 delta, and the $100 strike price has a good amount of volume on it. And if you had $10,000, you could do either of these. I mean, you could go lower as well, right? You could go lower, but I think in 22 days, mm, 22 days, how much would you get paid? About $100. That's pretty good. $100 for less than a month on 10,000 cash. This isn't the greatest kind of ROI you're ever going to see. And there's, I think, not just the ROI, but greatest numbers. A lot of times I do a lot of trades that I'm calculating return on buying power. In this though, we're just going to calculate return on cash. So it's not going to be as impressive as the return on buying power. But 10,000, let's see. If we made about, looks like we might be able to get $105. We brought, no, let's see. Actually, it should be tying up 10,000 cash divided by, yeah, that seems off. Let's try the 105 divided by 10,000 of cash. Yeah, like a 1% return. Yep, 1% return in less than a month. Now, a lot of people they don't get impressed with this 1% return. But when you do that, if you're able to do that for 12 months, you're looking at annualized 1% a month, you're looking at 12% annually. And our whole thing that we're trying to do is annualize our ability to pull money out of the stock market, annualize our attention on this. So if this is a relatively low risk trade, like what's the worst thing that could happen? The worst, okay, what's the most likely worst thing that could happen? The most likely worst thing that could happen is that for some reason Robinhood dives down over $16 in 22 days, which you see this number right here. This number is almost 13. The Thinkorswim computer is calculating that it would not be shocking if it moved down $13. But 16, that's $3 outside of that range. So and that's probably, I'm guessing, if we looked at a standard deviation, that would be one outside of one standard deviation. And we could do that by going over to the risk profile, putting that trade on the putting that trade on there, and that is what I do. 35 minutes. This is a long, long video. But if you watched any of this, especially towards the end, I hope you learned a little bit about selling options and option chain in general. And hope you learned that. Hope you learned some stuff. I gotta go. Bye.